When you think of a bank, what's the first thing that comes to mind? A building on your local high street where you deposit and withdraw money, or the phone app that you use to transfer and receive money. But did you know that there is a type of bank that doesn't hold accounts for you or me? A bank that literally creates a country's official currency. Keep watching to learn all about central banks and how they control interest rates. Every nation or region has a central organisation in charge of managing their economic and monetary policies and ensuring a stable financial system. This organisation is known as a central bank, not like a regular bank, a central bank. Each central bank operates slightly differently, but there are a few key responsibilities they tend to share. The primary goal of pursuing price stability. This is done by controlling inflation and maintaining steady GDP growth. The lender of last resort title. So that means that they're responsible for providing their economy with money when commercial banks can't cover a shortage. So a central bank literally prevents the nation's banking system from going kaput. And then also the control of a country's monetary policy and money supply. So this means that they are typically the only producer and distributor of all notes and coins in circulation. Must be a very impressive printer. And I've just realised I've mentioned monetary policy twice and I've not explained what it is. Monetary policy is what a central bank or government can do to influence how much money is in an economy and how much it costs to borrow. So a good example of action they can take is by adjusting the bank rate, which is the interest rate a central bank charges banks to borrow money from them. Now, back to regular programming. They typically exist and operate separately from the government and regulate a nation's member banks. They also regularly produce publicly available reports and share information and statistics on things like how the economy is performing, for example. With US dollars being used for about 90% of all the world's currency transactions, the US Federal Reserve, aka the Fed, is definitely one of the most influential central banks in the world. Overseer of the Eurozone policies, the European Central Bank, or ECB, is definitely up there. Honourable mention to the Bank of England, of course, Bank of Japan, Swiss National Bank, Bank of Canada, and the Reserve Banks of Australia and New Zealand. An interest rate shows how high the cost of borrowing is or how high the rewards are for saving. I'm actually learning to drive and will be on the hunt for a car soon, so I need to consider my options for getting said car. Option 1, I choose to borrow money to buy my car. Interest rate is the amount I will be charged for borrowing the money, and this is typically shown as a percentage of the total amount of the loan. The higher the percentage, the more I have to pay back. And this is dependent on the size of the loan, of course. Option 2, I decide to save money to buy my car. So the savings interest rate would be how much money is paid into my account, again, as a percentage of my savings. The higher the savings interest rate, the more will be paid into my account. This again comes down to how much money I'm actually saving. In a nutshell, central banks set interest rates to control inflation and promote growth. It sounds simple, but it's a very big task. They may raise interest rates to bring high inflation down and slow down an economy. And I know you're probably thinking, how does that affect me? Don't worry, I got you. Raising interest rates increases the cost of borrowing because loans now come with higher interest rates. This also makes the costs of buying goods and services more expensive. So consumers, you and I, and businesses spend less and save more. This reduces the overall demand for goods and services, a process also known as the law of supply and demand. On the other hand, central banks may lower interest rates to stimulate growth. So this will encourage you and me, businesses, to spend more and borrow, which can help grow the economy. By carefully balancing the need for growth with the need to control inflation, central banks play a crucial role in maintaining the economic stability. Central banks have loads of things they can do to influence interest rates. This includes setting the rate at which banks can borrow money from them. Remember when I talked about bank rate earlier? And buying or selling government securities. Wrap-up time. 1. Pretty much every nation or region has some form of a central bank. 2, central banks manage the flow of money in economies. 3, a central bank's ultimate goal is price and economic stability. And 4, the most influential tool a central bank has at its disposal to achieve this goal is the ability to raise and lower interest rates. So, there you have it. If you enjoyed this episode of BlackRock Basics, give us a thumbs up.